Imagine this. The most powerful financial system in the world is stuck in a corner. If they print money, Bitcoin explodes. If they don't, the economy cracks, and Bitcoin still wins. There is no easy way out anymore. And right now, we are watching this trap unfold in real time. In 2026, something strange is happening. Inflation didn't fully disappear. Interest rates are still painfully high. And global debt is growing faster than ever before. The Federal Reserve is trying to control all of this at the same time. But here's the problem. They can't. And once you understand why, you'll see why Bitcoin might not just rise. It could explode. Let me ask you something. What happens when a country owes too much money, but also can't afford to stop borrowing? That's exactly where the United States is right now. Debt has crossed historic levels. And the scary part? The cost of maintaining that debt, interest payments, is rising fast. Now here's where things get complicated. To fight inflation, the Fed raises interest rates. Sounds good, right? But higher rates make that massive debt more expensive to manage. So the government ends up paying more, which forces them to borrow even more. It's a loop. Raise rates, debt gets worse. Lower rates, inflation comes back. There is no clean solution. This is what experts quietly call a policy trap. And this is where things get serious. Because when trust in traditional systems starts to shake, people begin looking for something different, something outside the system. Now think about Bitcoin. No central authority, no money printing, no manipulation from a single entity, and most importantly, a fixed supply. Only 21 million coins, ever. Now ask yourself, what happens when trillions of dollars are constantly being created, but one asset stays limited? That difference changes everything. We've seen this pattern before. In 2020, massive money printing led to a surge in Bitcoin. In 2023, banking instability pushed people toward alternative assets. But here's the twist. This time, it's not just retail investors jumping in. It's institutions, big ones. And they're not loud about it. They're moving quietly. Let me explain something most people are missing. Bitcoin is no longer an outsider asset. It's slowly being absorbed into the financial system. ETFs have made it easier to access. Regulations are becoming clearer in many parts of the world, and major financial players are starting to treat it seriously. This is a big shift. Because institutions don't chase hype. They position early. Imagine this. If even a small percentage of global wealth, say 1% or 2%, moves into Bitcoin, the impact would be massive. Why? Because supply is limited, and a large portion of Bitcoin is already locked away by long-term holders. So when demand increases, there's simply not enough supply available. That's when prices don't just rise, they jump. But here's the part nobody talks about enough: liquidity. This is the real driver of markets. Not news, not hype, not social media. Liquidity. When there's more money flowing in the system, assets go up. When liquidity dries up, everything struggles. Now here's the critical question. What will the Federal Reserve do next? If the economy slows down, if unemployment rises, if markets start breaking, they will be forced to act. And historically, central banks always choose the same path. They inject liquidity, maybe slowly at first, maybe indirectly, but eventually they do it because the alternative is worse: a deep recession, mass unemployment, financial instability. And every time liquidity returns, Bitcoin reacts faster than most assets, not because of hype, but because it's one of the most sensitive assets to monetary expansion. And patterns matter. Now let's talk about something everyone thinks they understand: the Bitcoin halving. You've probably heard about it. Supply gets cut in half. Sounds simple, but here's what most people miss. The real effect doesn't happen immediately. It builds over time. Less new supply enters the market. Meanwhile, demand slowly increases, and eventually, supply can't keep up. That's when things get explosive. Now combine that with everything we just discussed: institutions accumulating, potential liquidity returning, and a shrinking supply. That combination is rare and powerful. But here's the uncomfortable truth. Even when all the signals are there, most people still miss it. Why? Because of psychology. Fear when prices drop, greed when prices rise, doubt when things feel uncertain. Bitcoin is volatile, and that volatility shakes people out. Think about it. How many people bought Bitcoin early, but sold too soon? How many people waited for the perfect time and missed the move completely? This isn't just a financial game. It's a psychological one, and the market rewards patience more than prediction. Now let's break this down clearly. Why is all of this happening? Because the global system is under pressure. Debt is too high. Inflation is still a risk. Growth is slowing. The system needs constant support. And that support often comes in the form of liquidity. Who benefits from this? People who understand the cycle early. Long-term investors. Institutions positioning quietly. Those who focus on fundamentals instead of noise. Who loses? People holding only cash while its value slowly declines. Late buyers entering during peak hype. Short-term traders reacting emotionally. And here's a hidden factor most people ignore. A large portion of Bitcoin is no longer actively traded. It's held, locked away, which means the actual available supply is even smaller than people think. Now let's talk about the real risk. What happens if you ignore all of this? Nothing. At first, life goes on. But over time, you may start to notice something. Assets rising, prices increasing, opportunities passing by, and slowly the gap widens between those who positioned early and those who didn't.